So question, where did you get your training?
I went to Chico State and graduated with a 2.6 GPA. And then, yeah,
You started off with.
yeah.
So how did you go from that to the?
Yeah. So like my dad has traded options since the 80s. So I just kind of knew what that was. And then typical to you guys, I looked at some taste trade stuff. I rolled on to what Tammy had. I got into the Pong group where, Dan and Tammy and myself were kind of proctoring. And basically, the way I relate to this is like all learning is in relation to once you do something enough, you're able to recognize patterns, then you're able to utilize patterns, and then you're able to create those patterns. So I've just done it for 10,000 hours. I can tell you I've done over 1 million back tests. And then I've also like made a living from trading and did over $1 million trading last year in zero DTE. So it's just like the fact of that's how mastery is harnessed through actually doing.
Mhm. Yeah.
And the other thing I like about zero DTE, which is I think appealing to everyone, is there's the concept of compound knowledge. So like if you're doing monthly expirations, you learn how to manage or like tweak it, but you don't get that much feedback and repetition. Whereas with zero DTE, you get feedback and repetition every day. The other thing I also like about zero DTE is if we talk about opinion or trend indicators or whatever, I'm not to say there aren't some geniuses out there that could predict market conditions, but like if you have sold puts in the NASDAQ and like you lightened up during 2022 because of your opinion, you've killed it. However, that's like not really mechanical. And since you're selling weeklies or monthlies, that time frame hasn't necessarily shaken out all the bad actors. Whereas like if you're trading on opinion or sizing differently based on your conviction of what the zero DT market looks like, you'll know in 3 months whether you actually can tell a technical indicator or you just want to be purely math based. And being purely math based is the way to go because the largest advantage we have, this is if anyone's seen A Bug's Life, we're like the ants against the rich people in New York City here because this market at max you could do 5% of the contract volume of the open interest at a strike. So that's maybe $50 million a year in premium sold. Wall Street hedge funds could come in and do 200% in this market. However, they'd only make 50 million bucks because they could only use stop loss orders up to that size. That would be a rounding error on a $5 billion portfolio. So like you're competing against regular people. And this is really like you have the advantage over everyone that's large. I like to say you're a tractor supply company in a town that's too small for a wool.